All right. Good afternoon, everyone. This is Megha here from ClearTax. So I think we have sufficient attendance, and since there is no change, we will begin the webinar as is. Firstly, I would like to thank Opportune HR for giving us this opportunity to conduct the webinar today. I will, share my the screen here. Please confirm if you can see the PPT. Maybe, give a thumbs up. That will really help. All right, please let me know if you all can, see the PPT. Yes, can you see it in the presentation mode? Yeah, all right, thank you so much. All right, so today's session is on financial wellness and tax savings. The reason why we are doing this webinar now is for twofold benefits. One, for the upcoming year, you can go ahead and plan your taxes, your investments, etc. And secondly, as we know, the return filing deadline is also nearing. So, this webinar will also help you understand how to choose between the regimes, because in one of the segment we are discussing the new regime versus the old regime. So this webinar will help you understand what are the differences between the two regimes and which regime may be more optimal for you depending on your income level, your investments, etc. And at the same time, if you have missed out claiming any of the deductions or exemptions in the previous year, how can you do so at the time of filing your returns? So this is the broad agenda of the webinar. Now let us take a look at the granular level agenda. First of all, we will be discussing tax exemption of HRA and LTA. Then we will be discussing other expenses eligible for deductions, that is apart from HRA and LTA, what other alternatives one has, tax benefits on housing loan, investments under Section 80C, pension products, going beyond 80C. Then the new regime, what are the highlights for the current assessment year? Then the tax slabs under both the regimes. And lastly, we will be doing a comparison. Also, we will have a dedicated space for a Q&A at the end of the session. So if you have any questions, please leave them on the chat box or the Q&A box, and we will take up the questions one by one at the end of the session. So thank you so much. With this, let us begin the session. So first up, when we're talking about deductions and exemptions, we discuss HRA, because HRA is the most common exemption which all the taxpayers go ahead and claim. Now, if you're receiving HRA as part of your salary, 3 criteria are to be considered, and the least of these 3 criteria will be the exempt amount of HRA. So let us take a look at these 3 criteria. The first criteria is we look at either 40 or 50% of your basic salary. So if you're residing in any of the 4 metropolitan cities, that is Delhi, Mumbai, Kolkata, or Chennai, in that case, you can claim up to 50% of your basic salary for HRA purposes. If you're residing anywhere else in India, in that case, you go ahead and claim 40% of your basic salary. The next criteria is the actual amount of HRA that you have received. The last criteria to be considered is your actual rent paid minus 10% of your basic salary. So the least of these 3 will be the exempt amount of HRA. Now let us take a numerical example to understand this. Let us presume that you're staying in Bangalore. So if you're staying in Bangalore, you claim 40% of your basic salary. Let us say 40% of your basic salary comes up to rupees 4 lakh. Now the actual amount of HRA that you receive is rupees 5 lakh, and your actual rent paid minus 10% of basic salary is 4 lakh 50,000. So we have 3 numbers, 4 lakh, 5 lakh, and 4 lakh 50,000. 4 lakh being the least will be the exempt amount of HRA from the actual HRA of rupees 5 lakh that you're receiving. And the balance amount of rupees 1 lakh will be taxable. All right, I hope I'm clear here. And the most important thing with regard to HRA is HRA can be claimed only under the old tax regime. I repeat, HRA can be claimed only under the old tax regime. Now, next up, we have leave travel allowance. Now, leave travel allowance like HRA can be claimed only under the old tax regime. Although leave travel allowance does not give out any monetary limit, it has certain conditions that must be fulfilled. The first condition is that LTA can be claimed only for domestic travel. And domestic travel alone. You can claim round trip expenses when you have traveled either by first class train or economy, and where a destination or where 2 places are not connected either by way of rail or by way of a flight, then any recognized form of public transport that you have traveled in, you can claim the round trip expenses of that journey. All right. And secondly, LTA can be claimed only twice in a block of 4 calendar years. Now, this block of 4 calendar years is given to us by the IT Act itself, that is the Income Tax Act. The current block is from the year 2022 to 2025. So in this block, you can claim 2 round trip expenses, and this can be claimed not just for yourself, but also for your spouse, your children, and your dependent parents or siblings. Now, if in any of the block you have not gone ahead and claimed your LTA, or you have not been able to claim LTA for some reason, then any unutilized LTA from any block can be carried forward to the first financial year of the upcoming block. So the upcoming block will be from 2026 to 2029. So if you have missed out claiming LTA in the current block, then in the first year, that is in the year 2026 that is the first year of the next block, you will go ahead and be able to claim this unutilized LTA. I hope I'm clear. Now let us take a look at the other deductions which are available from your salary. First up, we have children education allowance. Now, children education allowance is allowed only under the old tax regime. You can claim a maximum of rupees 100 per month for 2 children, which totals up to rupees 2,400 per annum. Next up, we have children hostel allowance. Now, children hostel allowance can be also claimed only under the old regime, and it is allowed at the rate of rupees 300 per month for a maximum of 2 children again. So this comes up to rupees 7,200 per annum. Next up, we have professional and development allowance. Now, professional and development allowance refers to, an allowance given by your employer if you're pursuing any short course or any other form of education which will help you in the course of your employment, which will further your employment. In that case, it can be claimed on the actual amount. All right. However, it will be subject to the allowance given out by your employer. For example, you have incurred rupees 10,000 towards a course that you took. Now your organization is giving you 12,000 as professional development allowance. In that case, you can claim the entire amount of 10,000. On the other hand, if your HR or if your organization is giving you, let us say, rupees 8,000 as professional development allowance, in that case, your exemption will be limited to 8,000 rupees. I hope that's clear. And professional development allowance can be claimed only under the old tax regime. Similarly, we also have allowance for books and periodicals. Once again, this is allowed under the old tax regime. The exemption is based on the actual expenditure incurred, subject to the allowance received by your employer. Internet and mobile allowance also is allowed only under the new old tax regime, and it will be exempt on the actual expenditure incurred, subject to the allowance received by your employer. Lastly, we have food coupons. Whether they are called food coupons, Sodexo or Pluxee, they are allowed as a deduction under the old tax regime, and the limit of exemption is rupees 26,400 per annum. Now, please note that barring food and Sodexo Pluxee allowance, all the other allowance, that is your children education and hostel allowance, professional development allowance, books and periodicals, internet and mobile allowance, etc., these usually form part of your special allowance package. So if you want to go ahead and claim any of these allowances, you need to first connect with your HR and understand first if your organization is giving out these allowances. And if your organization is indeed giving out these allowances, then you need to request your HR that you want these allowances so that they can be removed from your special allowance package and become a separate line item. I hope that's clear. So now let us take a look at the deductions under tax benefits of housing loan. So if you have taken any housing loan, whatever is the interest that you're paying, on that interest, you can go ahead and claim a deduction under the Income Tax Act. Now, please note that housing loan interest repayment is allowed as a deduction only under the old tax regime. So currently, we will take a look at the interest allowance deduction. Later on, we will discuss the principal element. So if you have taken a housing loan, then you can claim up to rupees 2 lakh per annum for a maximum of 2 self-occupied property. Now, the most important thing with respect to housing loan interest is that it is allowed only from the year of possession. Let us say you availed a housing loan in the year 2020. However, you got the possession of the house in the year 2024. So you will be able to claim a deduction of the interest paid only from the year 2024. And whatever is the interest that you have paid between 2020 to 2024, that is known as pre-construction interest. Pre-construction interest will be allowed in 5 equal installments from the year in which you get possession. So if you have paid a pre-construction interest of rupees 5 lakhs, for example, then you will be able to claim it in 5 equal installments from the year 2024. Now, please remember the ceiling limit for claiming housing loan interest repayment is rupees 2 lakhs. You do not get a separate deduction for the pre-construction interest that you have paid. Now, the Income Tax Act also gives out a provision to the taxpayer to claim an additional of rupees 1,50,000 towards repayment of interest under Section 80 EEA. However, to claim this additional deduction of rupees 1.5 lakh, there are several conditions to be satisfied. The first condition is that the house must be purchased under the Affordable Housing Scheme or the Housing for All scheme of the Government of India. Secondly, the taxpayer must be a first-time home buyer. Next, the loan must be availed between the period 1st April 2019 to 31st March 2022 from a financial institution. Now, this is a very important condition. Next, the stamp duty value of the house property should be 45 lakh rupees or less. And there are also conditions with regard to the carpet area of the house, depending upon whichever part of the country that you're staying in or whichever type of city you're staying in. If you satisfy all these conditions cumulatively, only then will you be able to go ahead and claim rupees 1,50,000 as additional deduction for housing loan interest repayment under Section 80 EEA. So with this, we come to an end of the tax benefits on housing loan. Now let us take a look at investments under Section 80C. Before we do a deep dive under Section 80C investments, please note that Section 80C is allowed only under the old tax regime, and the umbrella limit for deduction is rupees 1,50,000. So irrespective of whatever is the deduction or irrespective of whatever is the investment that you have made, the deduction will be restricted to rupees 1.5 lakhs only. All right. So firstly, under investment under Section 80C, we have EPF. All right. So EPF is again one of the most common forms of investment. EPF refers to Employee Provident Fund. So you make a contribution to your employer for your retirement corpus. So whatever is the contribution that you make, that is eligible for deduction under Section 80C. Next up, we have Voluntary Provident Fund. Now, Voluntary Provident Fund essentially is an extension of your EPF itself. So if you want to contribute more than the statutorily permissible limits for EPF, then you can opt for the Voluntary Provident Fund. Next up, we have Public Provident Fund. So Public Provident Fund, as the name suggests, it is only for, not just, for your contribution at your employer, but it can also be opened for your spouse or your children. All right. So you can go ahead and open a Public Provident Fund account for your spouse or your child and including your own self. And the ceiling limit for the same is rupees 1,50,000. Next up, we have payment of life insurance premium. So if you have taken any life insurance policy, either in your name, your spouse's name, or your child's name, in that case, whatever is the premium that you're paying, you can go ahead and claim a deduction of the premium paid from the year of payment. If you all could please confirm if you can see the slides, because I see there are several comments saying that you cannot see the slides. So can I please have a thumbs up if you can see the slides? Currently, we are on the slide investment under Section 80C. All right. Thank you so much. Okay. So next investment under Section 80C is investment in equity linked savings scheme. So equity linked savings scheme is a form of tax saver mutual fund, wherein if you're going ahead and investing in a ELSS, and if the ELSS is coming with a lock-in period of 3 years, in that case, whatever is the amount of investment that you make, on that investment, you can claim a deduction under Section 80C. However, please remember that if you're incurring any capital gains at the time of maturity of these ELSS, in that case, you will have to pay short-term or long-term capital gains tax as applicable. Next up, we have repayment of housing loan principal. Now, housing loan principal is also allowed from the year of possession of the house. Any pre-construction principal, if you have paid, that is not allowed for deduction. Along with your principal repayment, you can also go ahead and claim stamp duty fee paid or any registration fee paid for the purchase of the property. Next up, we have fixed deposits investment. So if you have invested in any fixed deposits, you can go ahead and claim a deduction under Section 80C. However, please note that if you're investing in FDs, it has to be a 5-year FD only. That is to say, it has to come with a lock-in period of 5 years. Only in that case, the FD will be allowed as a deduction under Section 80C. If it is a 1 or 2 year FD, it will not be allowed as a deduction. All right. Next up, we have payment of tuition fee. So if you're paying tuition fee for any of your 2 children for admission in a school, college, or university, you can go ahead and claim a deduction of the tuition fee paid. Please remember, only tuition fee is allowed as a deduction. Any development fee, donation fee, or any other fee by whatever name called will not be allowed as a deduction. Next up, we have investment in Sukanya Samriddhi scheme. Now, this is a very lucrative scheme because at one hand, you can save for your girl child. On the other, you can also get certain tax benefits. So whatever is the contribution that you're making to your Sukanya Samriddhi scheme account for your girl child, that is eligible for deduction under Section 80C. However, there are certain conditions. One, you should open a Sukanya Samriddhi scheme account when your girl child is below the age of 10 years. The minimum contribution is 250 rupees per annum. The maximum being rupees 1,50,000 per annum. Next up, whatever is the year-on-year interest that you get under the Sukanya Samriddhi scheme account, that is also exempt. Lastly, at the time of maturity, whatever is the amount that you get, that is principal and interest both, they will also be exempt under the Income Tax Act. All right, and premature withdrawal will be allowed when your girl child turns 18 years of age, and this amount can be utilized either for her higher education or for the purposes of her marriage. Few other alternatives one can explore under Section 80CR: investment in National Savings Scheme certificate, senior citizen savings scheme investment, that is for people above the age of 60 years, ULIPs, post office scheme, NABARD bonds, etc. Now let us understand pension products. Now, pension products are divided into 3 distinct categories for the purposes of Income Tax Act. First up, we have investment in pension under Section 80CCC. So this refers to investment in annuity plan of LIC from an approved fund. The maximum amount of deduction allowed is rupees 1,50,000. Next up, we have contribution to pension scheme of the central government under Section 80CCD. Now, under Section 80CCD, there is twofold division. One division is for employees' contribution, the other for employers' contribution. Now, employees' contribution is covered under Section 80CCD1. So, if you yourself in the capacity of an employee are contributing to pension scheme under CCD1, then you can claim a maximum deduction of 10% of your basic salary subject to rupees 1,50,000. All right. However, the most important condition to be noted here is that the combined limit of deduction for Section 80C, CCC and CCD1 is capped at 1,50,000. So irrespective of the investment that you're making, your deduction will be capped at 1,50,000. Now let us take an example to understand this better. Let us say you have invested in Provident Fund rupees 1,50,000, in an annuity plan of LIC rupees 1,50,000, and your contribution to NPS under CCD1 is 1,50,000. So your total contribution is rupees 4,50,000. However, the deduction will be restricted to rupees 1,50,000 only. This is because of the condition laid down in the Income Tax Act. And this is allowed only under the old tax regime. Now, Section 80CCD2 refers to your employer's contribution to pension. So whatever is the amount of contribution that your employer is making, he can make a maximum contribution up to 10% of your basic salary. So your employer's contribution is also eligible for deduction. And please note that your employer's contribution is available for deduction both under the old tax regime and the new tax regime. And this is over and above the 1.5 lakh limit that we have discussed. Next up, we have additional contribution to pension under Section 80CCD1B. So if you have contributed to pension under Section 80CCD1B, in that case, you can go ahead and claim an additional of up to rupees 50,000. This is over and above the limit of 1,50,000 that we've just discussed. So continuing the previous example, wherein you had made an investment of 1,50,000 each under Section 80C, CCC and CCD1, if you go ahead and invest additional 50,000 rupees to NPS under CCD1B, in that case, your total investment is rupees 5 lakh and your deduction will be capped at rupees 2 lakhs. I hope I'm clear. Now let us move on to see what are the benefits available on payment of medical insurance or any other medical expenditure one might incur on treatment of various disabilities or diseases. So first up, we start with Section 80D. Now Section 80D is for payment of medical insurance premium. So if you have taken a premium on a life insurance policy, either for yourself, your spouse, your dependent children or parents, in that case, you can claim either rupees 25,000 if the age of the person is less than 60 years, or rupees 50,000 if the age of the person is more than 60 years. That is, the person is a senior citizen. These amounts can be claimed as a deduction under Section 80D. Now, please note that this can be claimed only under the old tax regime. And the condition of Section 80D is that whatever is the contribution that you're making for payment of premium, it must be made in an online mode only. If you're making cash contribution, that will not be allowed as a deduction. Furthermore, 80D also makes a provision for rupees 5,000 for preventive health checkup, which is included within the overall limits of 25,000 and 50,000 rupees. And preventive health checkup can also be paid in cash. Furthermore, Section 80D also makes a provision to go ahead and claim medical expenditure. Now, please listen carefully here. 80D makes a provision for claiming medical expenditure. This is allowed only under the old tax regime. You can claim medical expenditure up to rupees 50,000. Now, this 50,000 rupees can be incurred for your lab test, doctor visit, monthly hospital bills or monthly medical bills, etc. 50,000 is the per annum limit. However, there are two important conditions which a person has to mandatorily satisfy. The first condition is that the person for whom you're claiming this medical expenditure should be above the age of 60 years. The second condition is that the person for whom you're claiming this expenditure should not be covered under any existing health insurance policy. If you satisfy these two conditions, you can go ahead and claim a deduction under the old tax regime. Next up, we have deduction under Section 80DD. Now, Section 80DD is for differently abled dependents. I repeat, it is only for your dependents, and your dependent includes your parents, spouse, children, or wholly and mainly dependent siblings. Again, if the list of disabilities given by the Income Tax Act itself, the disabilities include autism, blindness, low vision, hearing impairment, etc. If the degree of disability is more than 40%, less than 80%, you can claim a flat deduction of 75,000. On the other hand, if the degree of disability is more than 80%, you can go ahead and claim a flat deduction of 1,25,000 rupees. Now, please note that if you're claiming this deduction, it is mandatory that you get a prescription from the doctor. And secondly, it is mandatory you fill Form 10IA at the time of filing the return of income. Next up, we have deduction under Section 80U. Now, Section 80U is a mirror provision of Section 80DD. All the conditions which apply to Section 80DD, that is with respect to a degree of disability, the quantum of deduction, or the disabilities included, are the same. The only difference is that 80U is for you yourself. If you yourself are suffering from any of the disability, then you claim a deduction under Section 80U under the old tax regime. Next up, we have deduction under Section 80DDB. Now, Section 80DDB is for medical treatment of certain diseases like malignant form of cancer, dementia, Parkinson's, AIDS, thalassemia, etc. And this is available only under the old tax regime. So, depending upon the age of the person, you can claim either 40,000 or rupees 1 lakh. If it is a non-senior person, you claim 40,000 rupees or actual expenditure, whichever is lesser. If it is a senior citizen, you claim 1 lakh rupees or actual expenditure, whichever is lesser. And lastly, please remember you have to get a prescription from a specialist doctor, and whatever is the amount you get from your insurance company or your employer, if you have taken, top up, or if you have taken insurance with your employer, that amount must also be excluded to compute the deduction under this section. So moving on, next up we have deduction under Section 80E, that is for interest on education loan. Once again, it is allowed only under the old tax regime. If you have taken any educational loan from any financial institution or any approved charitable institution, then whatever is the interest that you're paying, that will be allowed as a deduction. The maximum period of deduction that you can claim is for 8 years. Now, this loan must be taken for higher education purpose, and this loan can be taken either for the higher education of your own self, your spouse, your children, or for any other person to whom you are the legal guardian. Please remember, if you have taken a loan from family or friend, that will not be eligible for deduction under Section 80E. Next up, we have deduction under EEB. So Section 80 EEB is allowed only under the old tax regime, and this is for purchase of electric vehicle. So the maximum deduction that you can claim is rupees 1,50,000 until the repayment of the loan. However, the most important condition is that the loan must be taken between 1st April 2019 to 31st March 2023 from a financial institution. If the loan is outside this window, then you will not be eligible to claim a deduction under Section 80 EEB. Lastly, we have deduction under Section 80G. Section 80G is for donations, and it is allowed only under the old tax regime. Now, depending upon the nature of the donee, deduction can be allowed either at the rate of 50% or 100% of the donation made. However, it is to be noted that cash donations above 2,000 rupees will not be allowed as a deduction, and it is mandatory you obtain a 80G certificate from the donee organization, because 80G certificate has all the details of the donee organization, which you will have to input in your ITR at the time of filing the return of income. Now let us move on and see the highlights of the new tax regime for assessment year 24-25. The biggest highlight is that the new tax regime has become the default tax regime. So that is to say, if you have not exercised option at your employer to choose between the regime, then by default, the new tax regime will be implemented and your month-on-month TDS and deductions will be as per the new tax regime. Next up, for salary taxpayers, standard deduction of 50,000 has been extended to the new tax regime. So far, it was eligible only under the old tax regime. Next up, under the new tax regime, rebate under Section 87A has been hiked from 12,500 to 25,000 rupees. Now, please note that the rebate under the old tax regime continues to be at 12,500. Only for the new tax regime, it has been hiked to 25,000 rupees. So essentially what this means is that if you're a salaried person and under the new tax regime, if your income is up to 7.5 lakh, then utilizing standard deduction and rebate under Section 87A, your tax liability becomes nil. How this becomes nil, we will discuss it in the upcoming slides. Next, surcharge has been reduced. The maximum rate of surcharge under the new tax regime has reduced from 37% to 25%. Now, this is a welcome move for taxpayers under the new tax regime, as if you have opted for the new tax regime and if your income is about 2 crores, then you will end up paying only 25% of surcharge. Lastly, the concept of marginal relief has been introduced under the new tax regime. Now, what is marginal relief? We will discuss it in a few minutes. Before that, let us take a look at the slab rates. The slab rates are as follows. Under the old tax regime, income up to 2.5 lakh is not taxable. 2.5 to 5 lakhs is 5%. 5 to 10 lakh, 20%. Income above 10 lakhs is taxed at the rate of 30%. The applicable surcharge rates are 10, 15, 25, and 37%. Cess will be applicable at the rate of 4%. Next up, under the new tax regime, the income slab of 2 to 3 lakhs will be not chargeable to tax. 3 to 6 lakh is 5%. 6 to 9 lakh, 10%. 9 to 12 lakh, 15%. 12 to 15 lakh, 20%. And above 15 lakhs, it will be taxable at the rate of 30%. The applicable rate of surcharge are 10, 15, and 25, and cess at 4%. Now, in the previous slide, I told you, if you're a salary taxpayer, then income up to 7.5 lakhs will not be chargeable to tax. Let us understand how. So this is the computation that we've done, wherein we have considered income from salary at 7.5 lakh rupees. With standard deduction of 50,000, your gross total income becomes 7 lakh. So there are no deductions under the new tax regime. So your total taxable income is 7 lakh. For a taxable income of 7 lakh, the total tax payable is rupees 25,000. However, utilizing the rebate under Section 87A, which is 25,000 rupees under the new tax regime, your total tax liability becomes nil. So that is to say, if you're earning 7.5 lakhs under the new tax regime, that does not mean you don't have any tax to be paid. There is a tax payable. However, utilizing the rebate, your total tax liability becomes nil. I hope I'm clear. Now let us move on to understand the concept of marginal relief. So here it is said that if you're a salary taxpayer and if your income is between 7.5 lakh to 7 lakh 77,778 rupees, then your additional outflow of tax will not be based on the slabs, but it will be based on the amount exceeding 7.5 lakhs. For example, if your income is 7.5 lakhs, that means you will have to pay taxes. Now, in the computation, we saw that if your income is 7.5 lakhs, the tax payable is 25,000. On the other hand, if your income is 7.6 lakhs, your tax payable becomes 26,000 without cess. Now, don't you think it's a little unfair? Because your income rose by 10,000 rupees, you end up paying 26,000 rupees in taxes. To eliminate this, only the concept of marginal relief has been introduced, wherein it is said that you will not end up paying 26,000 in taxes. You will only pay 10,000 rupees, because that is the amount by which your income has surpassed the 7,50,000 limit. Please note that this is for salaried individuals. Now let us analyze the old and the new tax regime. So in comparison one, we have taken income from salary under both the regimes at rupees 16 lakhs. Then we have standard deduction of 50,000 under both the regime. So the gross total income becomes 15,50,000. Now when we come to the deductions, we have taken the maximum deductions permissible under each of the sections under the old regime. So housing loan interest repayment, we have taken 2 lakh rupees, ATC 1.5 lakh, ATD, which is repayment of medical premium, rupees 50,000, ATCCD 1B. This is additional contribution to pension, rupees 50,000, and ATCCD 2 under both the regimes, because ATCCD 2 refers to your employer's contribution to pension, which is eligible for deduction under both the regimes. So now your total taxable income under the old tax regime is 10,50,000, and your total taxable income under the new tax regime is 15 lakh rupees. Let us take a look at the taxes. The total tax payable under the old tax regime is 1,32,600 rupees, and under the new tax regime, it is 1,56,000. Now, before we analyze this, let us take a look at another comparison. For comparison 2, once again, we have taken salaried income from both the regimes at rupees 16 lakhs, then a standard deduction under both the regimes at 50,000. So the gross total income under both the regime is 15,50,000. Now, when it comes to deductions, we have taken only that deduction which is allowed under both the regimes. So we know that employer's contribution to pension is allowed as a deduction under both the regimes. So we have taken that at rupees 50,000 under both the regimes. So now your total taxable income under both the regimes is same at rupees 15 lakhs. Let us take a look at the taxes. Under the old tax regime, the total tax liability is 2,73,000, and under the new tax regime, it is unchanged at 1,56,000. So now let us go ahead and understand the comparison. All right. See, if you look at comparison 1, under the old tax regime, your total taxable income was less at 10,50,000. The reason being that you utilized the maximum deductions available under each of the sections. So now, because your total taxable income under the old regime was less, consequently, your tax payout under the old regime also reduced, and under the new regime, it was higher in comparison. Now, in comparison 2, what we have done is we have taken the total taxable income at the same level. That is rupees 15 lakhs under both the regimes. Now, when your taxable income under both the regimes is same, in that case, the tax payable under the old tax regime becomes higher, and under the new regime, it is lesser. So what does one understand by this? The conclusion that can be drawn here is, if you're a person who is saving intensive, you have a lot of deductions, you have a lot of investments which are eligible for deduction under various sections of the IT Act that we've just discussed. In that case, the old regime may be more beneficial for you. On the other hand, if you're an expenditure intensive person, a person who has, a lot of expenditure, or a person, who has not invested a lot in tax saving options, in that case, the new regime may be more beneficial. However, please note that this is not a straitjacket formula. This is not a thumb rule. All right. Because again, when we are talking about taxation, we have to take a look at all sources of income. But for the purpose of this example, we have only considered your salary income. All right. So if you want to ascertain which surety, which regime may be more beneficial for you, I would request you can reach out to your nearest tax expert, or you can reach out to someone at ClearTax, and we'll be more than happy to assist you. So with this, we've come to an end of the presentation. Thank you so much for your time. We open the floor now for Q&A. So if you have any Q&A, please put them in the Q&A box and we will answer the questions. So Harsh has a question. Can you please share this PPT? Yes, Harsh, we will be sharing the PPT at the end of the session. So we have a question. Can you explain about NPS? So as we've discussed, NPS is allowed as a deduction under Section 80 CCD. So Section 80 CCD deals with your contribution to pension, and CCD2 talks about your employer's contribution. Your contribution is eligible for deduction up to a maximum of 10% of your basic salary, subject to rupees 1.5 lakhs. And your employer, and this is allowed only under the old tax regime. On the other hand, your employer's contribution, which is again restricted to 10% of your basic salary, is allowed under both the old tax regime and the new tax regime. Additionally, if you're contributing to pension under Section 80 CCD 1B, you go ahead and claim an additional of 50,000 as deduction. I hope that clarifies. Next question is by Parth. Will we be getting a recording of this session? Yes, Parth, you will be getting a recording of this session. Next question is by Mr. Ravindra. Can you go through some light on claiming housing loan interest? So Mr. Ravindra, we've already discussed housing loan interest in detail. I will open the slide for you. You can please refer to it. So under 24B, you can claim a maximum of up to rupees 2 lakh per annum for a maximum of 2 self-occupied property. And under Section 80 EEA, you can claim an additional deduction of 1.5 lakh if you satisfy all the conditions given out by Section 80 EEA. That is, it must be, a house under the affordable housing scheme. The loan must be between 1st April 2019 to 31st March 2022. The stamp duty value should be 45 lakh or less. Then there are also carpet area conditions depending upon the city that you're staying in, whether it is a tier 1, tier 2, or tier 3 city. So if you satisfy all these conditions, and also that if you're a first time home buyer, in that case, you're eligible for an additional deduction of 1.5 lakhs. I hope that's clear. So next question is by Jaya. Can we choose between two regimes every year? Jaya, yes, if you're a salaried taxpayer, then you have an option of shifting between the regime depending upon which regime is more beneficial for you. Next question is by Ms. Aparna. Can we get the PPT shared? Yes, Aparna, we will be sharing the PPT at the end of the session. Please don't worry about that. For housing loan, principal possession is compulsory. Yes, Shaban, if you want to go ahead and claim the principal, the possession of the house is compulsory because this is a condition laid out under Section 80C. So once you get the possession of the house, only then you can start claiming your interest and principal. However, with interest, you also have the flexibility to claim the pre-construction interest in 5 equal installments from the time you get the possession. There's a question by Mr. Ganesh. The amount taken from ATM can be exempted from tax. Mr. Ganesh, I don't follow your question. If you could please clarify what is it that you're asking? Next question is by Mr. Harsh. Hello, I feel there's a lot of difference between a bachelor and a family member. Can you suggest what a bachelor can opt to? Mr. Harsh, sadly, the Income Tax Act does not, differentiate between a bachelor or a family member or a male or a female. All the conditions, all the law apply equally to each and every person. However, if you want an in-depth analysis of, which regime may be more beneficial for you, what are the tax-saving investments that you have to look at, I would suggest you please connect with us offline and we'll be more than happy to help you. Our next question is by Ms. Jaya. Basically, there is a standard deduction of 50,000 and the option of investment in ATC, Mediclaim, HRA, donation, NPS, housing loan only. Apart from this, is there any option where one can invest and get tax benefit? Yes, Ms. Jaya, this PPT was specifically from a salaried perspective or from a person who's receiving salary. There are few other avenues depending upon, the income that you have got. For example, if you have got capital gains income, you can prevent capital gains taxes by investing it in another house property. So there are various avenues like that. But then the agenda and the objective of this session was to focus on tax saving investments, which are most popularly used amongst the salaried people. Uh, is it possible to switch from new regime to old one after 2 years? Yes, Mr. Path, if you're a salaried individual, you can switch between the regimes. If we purchase a house in October and the interest certificate is generated in Jan, then should we claim the entire year or the interest we pay to the bank for 3-4 months? Mr. Ravindra, if you have gotten the possession of the house, then typically the final interest certificate is paid only at the end of the year, and the final interest certificate is for the entire year. So yes, if you have gotten the possession of the house, then once you get the final interest certificate in the month of February or May, you can go ahead and claim the entire interest, provided that you stayed in the house and you had the possession. Next question is by Mr. Vijayan. VPF shall only be detected through company or shall be done personally? No, VPF is something you have to opt from your company itself. However, if you want to make any additional contributions to pension, you can also explore the option of contributing to Public Provident Fund. What is the difference between VPF and PPF, which is more beneficial? Mr. Vijayan, VPF can be only for in your name. And if you want to contribute more than EPF, in that case, you can opt for VPF, because as we all know, the contribution limit on EPF is 12% of your basic salary. But if you want to contribute more at your employer itself, then you can open a VPF account. On the other hand, PPF gives you a flexibility wherein you can invest, wherein you can open a PPF account and invest not just in your name, but also in the name of your spouse or your child. So that is the, difference in terms of flexibility. Also, there are, certain differences with regard to the premature withdrawal conditions, the lock-in period, and the interest rates. So this is something, if you're interested to explore, then you will have to reach out to an expert, and the expert can help you better. So apart from capital gains, what else options we have for tax saving investment? Ms. Jaya, we have discussed all the investments available for tax savings in depth. However, if you need more options, then it would also be pertinent for me to understand, what is your income level, what are the investments that you have. On that basis, we will be able to advise you better. So I suggest that you please connect with us, and we'll be more than happy to help you. So I think we don't have any more questions. We will wait for another minute and see if there are any questions. Otherwise, we'll end this session. So thank you so much for being a wonderful audience. So Ms. Jaya, I will, share the email of our coordinator with you. So you can, please feel free to get in touch with him. So Mr. Himang is our webinar coordinator for the day. So we have shared his email ID here. So you can go ahead and, connect with Mr. Himang. And depending on the conversation, we can take this forward. Right, I don't think we have any more questions. Thank you so much for being such a wonderful audience. We will, end the webinar here, and we look forward to more webinars in the future. And also thank you so much to Opportune HR for giving us this opportunity to conduct the webinar. It was very nice and very pleasant connecting with all of you here today, albeit virtually. So yes, keep in touch. Thank you, and happy tax filing.